The three biggest questions we get asked when it comes to how's the market are what are rates doing, how's inventory and demand looking, and what's going on with prices.
Hi, this is Moriah Wicker and Cassie DW with DW here in Plymouth.
Welcome to Selling the South Shore, Real Estate in Real Life.
Whether you're looking to buy, sell, or live like a local, we've got you covered. Let's dive into today's topic.
Hi guys, so we are last week we talked about a recap of what the 2024 market looked like in real estate. And this week, although we always say we don't have a crystal ball to predict the future, obviously as industry professionals, we do try to look at what we know happened and then take our best guess at what 2025 may look at. We try to break down the year by quarter, what we think might happen in quarter one. We have a much better vision for versus quarter four. Obviously, there are a lot of things, as we learned in the COVID era, that can happen that you would have never prepared for, that completely throw a wrench in what you think may or may not happen in the market. So we have joining us today, Mike Nielsen with Guaranteed Rate, and obviously, you know, me and Cassie. So when we talk about market predictions, obviously the data that we look at when we're explaining that data, the conversation's different for a seller than it is for a buyer. And yet the facts are what the facts are. So we know that the three biggest questions we get asked when it comes to how's the market are what are rates doing, how's inventory and demand looking, and what's going on with prices. So we're going to break down today's conversation into those three groups. And that's exactly why we have Mike here today to start us off with talking about interest rates. Mike, I'm going to read for you, and these are just like the Google AI averages. I'm going to read for you what Google says the average interest rates were by month, and then we can kind of talk about what we expect to maybe happen throughout the year and give our best guess, obviously, like I said, with quarter one being at the forefront. So here they go from January to December. So we were 6.6, 6.7, 6.8, 6.9, 7, then 6.92, 7, 6.4, 6, 6.7, 6.5, 6.7. So obviously we lived in the top half of sixes, although I know that we had clients towards the end of August, early September you guys were breaking the barrier on the 5% range. So what do you think is going to happen next year?
I'm anticipating a lot of the same. I think that's the big part of what I'm pulling out of the past few years is not even leaning so much on any of the speculators anymore. Because I remember in 2022 when, even Fannie Mae and Freddie Mac came out and they were wildly off as to where rates were going to end the year 2022. They were wildly off 2023. Everyone was wildly off 2024. So I think we're being very optimistic about where the rate market's going. And then the market's telling us a completely different story and rates are remaining elevated. So even when we're seeing that range get tested on the low side and we're seeing rates start to go down, it comes right back up. So we're very news headline driven right now in the rate market. And I don't think we see stability in rates trending downwards until that's removed from the market cycle. And what I mean by that is until the market stops reacting to news headlines and that volatility has like dissipated the air, right? Like it's kind of like, all right, we're all set. We're good. The past market's behind us and rates are heading in this direction and we're stable. And news headlines coming out don't make the rates go in either direction, wildly left or right? I think for the immediate future, though, we're going to still stay in that market for a little while, which means we're going to see rates go 7+ for a little bit. And then we'll see rates go maybe into the low 6s for a little while. So it's going to be very annoying for buyers, right? And sellers that are trying to plan their life and budget their expenses and do everything. And one week they talk to the lender and their interest rate's 6.25. And the next week they talk to the lender and the interest rate's 6.875, which could make or break someone making a move. So I think the big thing is to just kind of be ready for that and be ready and poised to pull the trigger when the timing makes sense for you independently.
You know, we talk so much, and honestly, one of our recent videos was about that prepping, planning, getting everything set, ready to go. So exactly like you said, Mike, it's when it comes up and that house that you love is there, we know you're ready and we can jump right on it.
Yeah.
Cassie, do you have people ask you why, hey, the Fed just met and there was this big interest rate cut? Do you have people that then, ask about that?
Oh yeah, all the time. They're like, oh yeah, the Fed's cutting the rates, right? 0.5%. So now we're going to be able to, afford the house. And Mike, you want to speak on that? When the Fed cuts, what happens with mortgages?
It's been a fun year explaining that. So as you went through that timeline, that low point where we were around 6 and there's some scenarios in the 5s, that was right before that Fed rate cut in September. So the Fed cut rates 50 basis points in September, but the market had anticipated, and when I mean market, I mean the bond market. The bond market is the number one reason why rates do anything, right? Wherever investors are putting money is what is the direct cause and effect of where rates are. So if investors aren't putting money in bonds, mortgage bonds, rates are going to go up. If investors are putting money into mortgage bonds, rates will go down. So there was a big buildup into the Fed meeting in September. And the buildup was money flowing into the bond market, anticipating a friendly Fed, inflation's over, trying to get to that stability, trying to get to that point that I was talking about earlier, that the volatility is removed and, we can kind of move past this market cycle. The market's waiting for that, right? There's a buildup of money. Investors are sitting on a ton of cash right now. Hedge funds are sitting on a ton of cash right now. Everyone's cash rich. Everyone's a little nervous to put money into stocks, a little nervous to put money into bonds because no one knows what's going to happen. So that big buildup to the Fed meeting. And then when the Fed came out and cut by 50 basis points or half a point, that's their overnight lending rate. That's not directly mortgages. And their talking points during their Fed meeting was very counter to what everyone was anticipating they were going to be. And then interest rates started going up right afterwards, which means there was less money flowing into the bond market, particularly to mortgage bonds. And then right after that, we had a really strong jobs report, which kind of solidified the direction we were heading in with interest rates. And since then, as you can see in those data points that you pulled up, rates have done nothing but remain above pretty much 6.5% from September onwards to right now, right? And that's because we've kind of continued to get those mixed signals. We're getting, lower unemployment and then higher unemployment. We're getting low jobless claims and then higher jobless claims. We're getting low jobs report, high jobs report. We're getting relatively steady, higher inflation that's not really in target where the Fed wants it to be. And the Fed's most likely going to cut rates tomorrow by 25 basis points, and they even cut rates in November by 25. So for the Fed rate, which the Fed rate directly impacts HELOCs, home equity lines of credit, credit cards, anything short term, you're going to see credit card rates go down, you're going to see auto loan rates go down, which are all really good for the consumer, but it's not directly tied to mortgage 30-year fixed rates. Those are more bond driven. But the bond investor is a little spooked right now by kind of what they're seeing in the tea leaves of inflation sticky. Yeah, we're cutting rates, but there's some volatility there that makes buying. I think I was watching a quick note from someone on MSNBC where the headline was literally, I would not buy fixed assets right now, which a mortgage bond is a fixed asset. So you have a talking head on a big news network saying, don't buy fixed assets. That's probably going to have a bad cause and effect to mortgage rates, because then if that's how that person's thinking, and this person is running a big investing institution, right? They have power. And do we want to put $1 billion into mortgage bonds this month, right? If they say, no, let's not invest $1 billion into mortgage bonds, that's going to impact mortgage rates, right? So if that's where the market is viewing it, and by market, I think like Wall Street, right? So those big hedge funds, 401k plans, union annuities, insurance companies play a big role in the market. The Fed itself, when interest rates were as low as they were during COVID, one of the main reasons why rates were so low during COVID is the Fed was a buyer of mortgage-backed securities or mortgage bonds. So when the Fed is buying mortgage bonds at big, giant chunks, they can inorganically drive rates down, right? We don't have any of that going on right now, and fixed assets aren't a good class to be in when you have inflation. So it's just a really quirky market because on one hand, you have the Fed, which is in the news cycle more than it's ever been in history. So you have consumers that are asking you guys, wait, when the Fed cuts rates, what's going on with mortgages? That was never something that I talked to clients about 5 years ago, right? They didn't know what the Fed was. No one was paying attention to this. It was just, what are my rates today and can I afford a house? There wasn't this,
right?
Where are they going? Where are they at? The Fed's going to do that, this, that, and the other thing. It's so front and center now that the consumer is almost paying too much attention to it, right? That's something I'm always trying
so
to
if I so if I am a consumer and I am, like you said, people are so much more dialed in now to what the Fed is doing and what they're not doing, and I see, and because like we had clients exactly in this, like they're like, okay, yeah, we're gonna buy this house at 6%, and then kind of struggled to keep putting their next foot in front of the other. And found that rates were ticked up and that monthly payment went from making sense but being at the max of their budget to now being out of budget.
Yeah.
But if my credit card if credit card interest rates have gone down, or maybe auto loan interest rates have gone down, but my mortgage rate that I'm on my pre-approval has gone up or stayed the same, and I was being told by my uncle's brother's cousin that the Fed's meeting and rates are going to go down by a whole percentage point. And now I'm like, oh crap, I shouldn't have listened to Uncle Joe's whatever. Yeah. Would it be advantageous at all to like call my credit card company and try and like get a lower rate on my credit cards, or transfer a balance over, or try to refi my auto loan? Or is that like potentially going to mess up my profile as a borrower?
As a borrower, anytime you can reduce your debt payments, particularly, right? So like, let's say for the example of refinancing your car, you already have the debt. Buying a new car that you don't have, that's the detriment, right? So that's, if I look at someone's profile and I'm like, okay, here's what you're qualified for based on your current standing. Let's call that the control. So your control is that initial pre-approval. But then you add a variable to the control and you go, well, I'm going to go buy a $600 a month Tahoe. That's going to change your profile, right? We're bringing new information in. But if I run your scenario and you already have a $600 a month Tahoe, and you go, well, I'm going to refinance that Tahoe to $450 a month, right? That's better for your profile. That $150 a month, depending on the full scope of everything, that might translate to some sizable purchase power on the back end of buying a house, right? Because $150 in mortgage payment is going to go further than $150 on a 5-year car loan, right? If that makes sense, because it's spread out over 30 years. So you're able to take on more mortgage debt and kind of fill that deficit, or just have a more, elbow room to feel more confident to buy more house, right? If that makes sense.
Right.
So I don't think anytime you're replacing debt with better debt, it's a bad thing. That's usually a better thing. It's the additional debt that hurts you.
Okay. So wrapping up rates. So we think for next year, we'll probably see a lot of the same, and maybe like for our clients in 2024 that didn't pull the trigger, maybe just be really dialed in to when they hear from me, you, or Cassie, hey, now's the time. Because I know that all three of us, because we have a lot of the same clients, or we're talking about the market in general. Yeah. I know that we were saying to people in end of August, early September, now is a great time. This is the lowest the rate's been all year. This is when you should be pulling the trigger if they go up, and even kind of playing with a payment calculator to show them what 0.5% will do to their monthly payment. And it will be much more helpful to them to get the lowest rate possible than to try and get the seller to knock off $10,000. Like that $10,000 is going to change your payment by $32, but that quarter percentage change in rates, or like we saw, it went from, like looking at this, the average went from 6% to 6.7% in a matter of a month. Yeah. So that was probably what, like $400 difference, maybe something like that for like your average borrower right now.
There's a rule of thumb. I think it's every half a point takes 1 million buyers out of the equation, something along those lines.
Yeah.
Rates, and I could be completely wrong. So, but there's a rule of thumb there that as rates go up or down, we're either decreasing the buyer pool or increasing the buyer pool. So if rates go to 8% next month, we're going to decrease the buyer pool. There's just going to be a certain group of people that, unfortunately, based on what they make for money right now, won't be able to afford houses in their market because
and it's super sad.
Yeah.
And it's super sad to see the buyer get like knocked out, like from that growth. Like not only do we see buyers that, okay, your monthly payment may have just gone up, but also like some buyers just completely get like knocked out, you know, from the market in general. So in 2025, when we say to you, because the last thing, who knows, for all we knew in August, September and October could have gone to 5.75. Yeah. All I can tell you is what I know right now. They're the lowest they've been. So when we tell you in 2025 that rates it's a good time, you should take action before it's too late. So shifting on to inventory in 2025, something we didn't see in 2021, 2022, even really in 2023, but we did see a lot of in 2024 that may play into a benefit in 2025 are expired listings. So Cassie, do you want to talk about what potentially we have for inventory that we might see come on in?
So talking about expireds, definitely throughout this year, we saw a trend, especially, honestly, I feel like it relates a lot to the interest rates as well. And then just kind of the seasonality we've been seeing in here. Let's see, we do only have 10 minutes left to record, just to let you guys know.
We got it.
But so with expireds, we noticed, in quarter one, we saw almost 100 listings here in Plymouth County expire. And what that means is these homeowners tried to put their house on the market and it actually didn't sell. And exactly like you were saying, Moriah, I mean, 2020 through pretty much 2023, you didn't see that happen. If a home was listed, it was gone in the first weekend. So what that means, especially for our buyers, is the ability to, when the rates are right and when it makes sense for your family financially, you have a better chance of getting a deal. There's definitely some trends with different times of year that we see this inventory kind of creep up. This year, right now in quarter four, which isn't even over yet, and we're already at 101 expired listings, whereas the rest of the year, the highest we've seen is around 80. So, we're seeing this winter market definitely slow down a bit for the sellers, and it is a great opportunity for you to be able to cash in, getting something under ask, with contingencies that you probably couldn't do in quarter two when we only saw 54 expireds, about half. So it's the seasonality that we're seeing, I think, along with this kind of up and down volatility with the interest rates is definitely, depending on what you're looking to do, there's some opportunity.
It seems like too, like if someone was listing like in quarter four based on what they saw close in quarter two, which we know now was like the best quarter of 2024, and then at the same time a buyer's interest rate is on the rise, that was not a great recipe for sellers in quarter four. If you priced based on Q2 when everything was selling at 104%, and then you're now being kind of book jammed against a rising interest rate, that wasn't great. Because like basically looking at even solds, it's almost like 10% of the market was expiring. So maybe a benefit for buyers in 2025 is some of those sellers will go into the new year with maybe a clearer mind, or maybe put on in the spring. So maybe we'll see a little bit of increase in inventory for the new year with people that failed the market. That looks like right here. Yeah, there's about 350 homes on the South Shore. And when we look at just so you know, Mike, when Cassie and I talk about our numbers for inventory and sales and things like that, we do like the meat of the South Shore. So pretty much like the Route 3 corridor is what we tend to pull. So there's about 350 homes that didn't sell in 2024 that maybe those, even if only 75% decide to try again 2025, they hopefully have a good agent that looks at this data and says, well, you better shoot your shot in February, March, April, or May and not do what you did. What about like maybe some expectations with inventory? Like I know, Mike, you were talking earlier about your sell buys, and I gave the example of myself as someone that I may enter the market as a buyer in 2025, but I'm one of those people that doesn't want to give up my 3.5% interest rate. So even though I'm becoming a buyer, I'm not bringing inventory to the table because I'm going to turn the home that I own into a rental property.
Yeah. I mean, so I think there's going to be, as rates come down, it's going to feel better because buyers are going to look at the numbers and go, yeah, I can afford more. That's just going to feel better, right? You're going to see more sellers enter the market too. From that standpoint, the opposite of you, where they go, all right, I'm at 3%, but there's a big fraction of people out there that don't want to be landlords, particularly in Massachusetts, particularly for a single family, right? They talk to someone like me, and I scare the pants off of them and tell them how horrible it is to be a landlord, because I think it's one of those things where you need to give them that gut check, because if I don't give them the gut check, and I don't know if you guys are similar, being a landlord's going to, right? And if I tell them all good is, and hey, being a landlord is great, you're going to make all this passive income and appreciation, and then the moment they get one bad tenant, they're like, this is awful. So there's a big fraction of sellers that just are never going to do that, right? They're just never going to put it on. So we'll see those hit the market as rates come down, because now they feel like the training wheels are off a little bit and they can re-enter the market and do their upgrades or their right sizing, whatever it is. But then there will be that fraction of people. I'm in that same category. We will never sell our house in market, right? We just won't. We'll end up renting it out and buying something else if we ever do move. And I don't even know if that's really rate driven. That's just something we've decided as a family, but we're in the industry. So I think we're lucky in the sense that we're in the space. So it doesn't feel daunting to be a landlord, but I know there's plenty of people that are willing to take that on too. So that
it's also part of what we do for work too. Like we're, elephant in the room, like we're all commission based. So we don't necessarily have, the luxury of a guaranteed paycheck. We also don't have probably great retirement or benefits that come with having an employer. So for us, it's also like a wealth building. I mean, not that we advise our clients also to think real estate in terms of building wealth and having assets, but for us, a lot of it is a security plan for our financial future.
And it's the complete opposite for the W-2 salary employee. It's the big reason why a majority of mortgages written today are 30-year fixed rate. You can set your watch to it. You know exactly what your payment's going to be. You can budget your life around your mortgage payment. That's a majority of the conversations I'm having with clients, is trying to fit into a payment, right? And so they can budget their life around it. Being a landlord is a wrench right into that gear, right? Because all it takes is 3 months of a tenant not paying you and your life's completely different, right? So I do think there's going to be a portion of people that are willing to do that, but I think there's also a big portion that just flat out aren't and are going to be willing to go, you know what, I'm going to go from 2.75 to 5.5. Okay, we could do that. I think the longer we've maintained a higher rate cycle, the less negative that's starting to feel, right?
Right.
In 2022, it felt daunting for anyone that talked to me about selling and buying. Like, I don't want to trade in 2.75 for 5%.
Yeah.
Now people in this market would give their left arm for 5%. So I think that scarcity in rate availability has really grounded a lot of sell-by clients that the main reason their payments going up, yeah, the interest rates matter, but it's because you're going from a $600,000 house to a $950,000 house, right? So I think that the rates do matter, and it's going to bring a lot of inventory to the market. But I think a big part of that payment jump up is also the house. You're changing the house.
Right.
I think a lot.
Yeah.
In my conversations, more people are willing to look past the rate a little bit more and not. A lot of people in 2022 were just going, oh, I'll just wait till rates come down. I think we're past that. We're past the
Yeah.
Right.
Rate thing. It'll just be
The
And
people
hopefully
that, yeah, no, definitely. And the people that need to make a move, you know, they say in 2020 to 2022, it's like we stole buyers from the future because they just wanted to get in because they could get in at a, 2-3% interest rate. But now it's those people that really want to make a move. They're growing out of their homes, or especially the downsizers, I think is a great opportunity because the equity they have in their home, they can sell, purchase something new without even looking into a mortgage. But yeah, it's those people that in the last 2 years, they wanted to hold off, but now they're really growing out of that home. And I feel like, they're going to be willing to make that trade, just like you were saying.
Yeah. I think the big thing is it's going to bring back in almost to the same, because Moriah, if you move, you're a net negative to the market. So you're just taking a house off the market. You're not bringing one on. I think we're going to see inventory go up with interest rates coming down, but we'll see absorption rates get tighter. We'll see houses come off faster. So it'll look better, but feel the same. It'll be like, hey, we have 5,000 single families on the market right now in Massachusetts, but houses are going off the market in 1 week, right? So you'll have more options, but we'll also see a lot more first-time home buyers enter and or re-enter the market, almost similar to you. There'll be a lot of net negatives out there that take out the market.
So for demand in 2025, we're anticipating probably, again, a lot of the same thing. We may see a little bit more options in inventory because we'll see some more sell buys because the interest rate won't be so glaring for someone making a trade in, and hopefully they're now getting so much equity that it kind of cancels out and the payment won't be such a big jump. We may see some more expireds come on the market, but we may also see, again, people now having enough equity that they can become a landlord and their primary residence can become their investment property and they can become buyers. And we may see more first-time buyers entering the market. So it will be interesting to see, on the one hand, yes, we may have a little bit more inventory, but the amount of demand that enters the market may just cancel it out. And like you said, Mike, will feel very similar. And honestly, that is economics 101, supply and demand. And that's what I tell clients all the time is we would need to see inventory come up 4 times for us to even enter a space where it doesn't feel like you're picking from, chicken or turkey. There's really no steak on the market right now. Okay. So for prices, so Cassie, what happened? I know we're talking about 2025, but if we want to look at what happened in 2024, we actually have to look all the way back to 2023. So what happened with growth in median sales prices in 2024?
Yeah, so with the kind of lower inventory of this year, even though a lot of buyers were out due to higher interest rates, prices still went up. And again, 2024, we started seeing a trend in 2023 with the seasonality, the winter getting softer, that list to sale price ratio getting lower, and then the big spring market boom. Things kind of start to slow throughout the summer, fall, and again, a very quiet winter. And that's really what we saw in 2024. So median sales price in Q2. And when we talk about Q2, yes, it's April to June, but most of these homes went under contract probably in February and March. And that's when we saw the biggest boom out there with the buyers. So median sales price then was around the 850 mark. And Q3 we've kind of crept closer to the 840 mark. And in Q4, we're actually sitting at like 814 right now. So really that seasonality of your spring market, which is really your, what do we say, after like Super Bowl Sunday through end of March, April, that's when you're really seeing prices out there getting a lot higher with that buyer demand in that spring market, and then really slowing down to right now in the winter. I know for the both of us, like we've gotten how many buyers under agreement, under ask in the last 2 months. I just had one, 40,000 under ask and negotiating money back after an inspection. So definitely with the prices, they are still they've grown throughout the year. So we still have appreciation. I think we're up about 5%.
Almost 5.5%.
Yeah, almost 5.5% year to date. So homes are still appreciating. However, the seasonality of this market is a big story for our buyers and sellers.
Yeah, because 4% is average. So for all intents and purposes, we had an average year in real estate where we saw appreciation. And like in some ways, as much as it kind of stinks, this is why interest rates are where they're at, because the whole point of the Fed leaving interest rates where they are is to control inflation. So unfortunately, it's just showing that interest rates where they were in 2024 and probably will, as we've said, be in 2025 is what's kind of keeping that rocket ship that was the COVID market kind of back on the ground, because it was the growth we saw in the COVID years in total. Like you look at those kind of 3 years as a whole was like 31%. So like we were saying today, like the $800,000 home in 2019 is now like 1.2. So, you just talked about $1 million being kind of your threshold for luxury. And now we're kind of talking about 2.5, maybe being that really high-end luxury threshold. So we're thinking, like you said, Cass, in 2025, we'll probably look at another year of growth. It's still, I would say, a seller's market. But like you said, if you're going to put your home on the market in Q2, not only are you probably going to get the highest list to sale ratio, it's your least chance of expiring. And I don't know about you, but that's when I had a lot of waived inspections. And the only time I had waived appraisals, not from the lender, but from the buyer themselves saying, you know what, this can appraise with a difference of $50,000 and I'm still in.
Yep.
What about on your end, Mike? What do you hear your clients talking about what they think might happen in 2025 or for pricing?
I think it's a lot of the I'm waiting for the market to crash. If we're talking about clients that are, because I feel like there's subsets of clients. There's the clients that are mission oriented, that are, this is what I'm doing, this is my budget, I'm gonna go buy a house. And we don't even have those conversations, right, with those clients. We're not talking about prices, because they're just really focused on their goals individually, right? And then if we're talking about clients that do start to lean in towards where they think things are going, the most of the talking points I get is, well, the market's going to crash. When is it going to crash? When's it going to happen? Mm-hmm. And where I peel
I just think of that Tom Brady image where it just shows him every year.
Better and better and better.
Like somehow. I do the same thing. So I'm very cause and effect with clients. So when they start heading in that direction, I remember I had a client back in 2022. He was doing the upgrading thing, selling the house that was his starter home. It was a nice house, but he's like, we're not in a neighborhood. I need to be in a neighborhood with my family. He's in my town of Marshfield. And he's like, Mike, when are prices in Marshfield going to come down? So, well, we don't build enough. There's not enough new inventory being built to do anything to resale prices. And it's going to be when people don't want to live here anymore is when prices come down. So as long as people want to live here, which makes it an attractable town, and there's not enough supply because we're not building enough, you're going to have pressure on price. That's just how it's going to go. And when prices come down, you probably don't want to live here because it's for reasons that you'd want to not live here. So it's as simple as that. And that's where I go with clients with, what's going to happen with price. My main focus is always try to bring them to the ground of focus on what you want to do, right? And if you're buying a house that you're going to own or live in for 5 to 10 years plus, price changes year over year in the near term are insanely inconsequential, right? Like if the market absolutely collapses in 2026, but you bought a house in 2025, but it's your forever house that you bought in 2025, you can't go buy that house in 2026 because someone else bought it in 2025.
Mm-hmm.
But once it's gone, it's gone. So if that perfect house that's like, oh my God, there's our 5-bedroom, 2.5 bath colonial in the neighborhood with the pool that fits our budget right now, we could buy this house right now. But we're going to wait for the market to crash next year. Someone else is going to buy that house right now because that house is on the market and has an expiration date. And
if you're going to be there, like it's like the saying of buying the worst house in the best neighborhood, it applies to buying the worst house in the best town too.
Yes. And typically with real estate I hate even using the word crash with real estate because I think words are insanely powerful. When I say crash or bubble, my brain goes to a bubble popping. That bubble's gone. It's gone forever. That bubble's never coming back, which applies to the stock market. If a company goes out of business and goes to zero and you've had stock in that company, you lost all of your money, right? If a plane crashes, you're probably never flying that plane again. That plane's gone. It's never being flown again. So it's a zero-sum word that's never applied to real estate because real estate's never gone to zero. So right. I think that a better replacement for that when you're having like conversations with clients or just how clients can think about it is there's moments of devaluation, right? 07, 08. And those moments are usually really short-lived because of supply and demand and because we all need somewhere to live. So typically when real estate goes down in value, it creates a buying opportunity and it comes right back up. So that's where I go with clients that start heading in that direction. They're like, well, what's going to happen with prices? And, I'm going to try to time it perfectly. And I'm Warren Buffett of real estate. That's really, really hard to do, right? Particularly if you're trying to buy a house to live in. Focus more on what's your budget and a house that you want to live in that fits your budget that you wouldn't mind living in during a moment of devaluation. Because if you're not going to sell it and you bought it for $750 in 2024, and it's worth $650 in 2026, but you're not moving, it doesn't really matter. Yeah, exactly. It doesn't feel good. You're not like thrilled.
I'm laughing too because the Warren Buffetts of real estate, which we all have had those conversations with those people. Yeah. Like I'm thinking back to when I first got into the business with people that were waiting for the market to crash. And of course I didn't know COVID was going to happen then, but like those people are still renting and like, I would be shocked to find Warren Buffett in a rental.
Yeah. Well, the big thing about Warren Buffett is a very simple investor. He just keeps buying and he buys things that he understands. So I think that's where I try to go with my clients is, and there's some people that you're never going to be able to convince otherwise, right? It's just their viewpoint. But if they're really sound in logic and they're trying to just make decisions for their family, which I think is a majority of people we talk to that are selling and buying real estate, right? It's a majority of people that are like, I want to go live in this school district. I want to live in this town. I want this type of house. Most of it's not money. And what I mean by most of it's not money, most of it's not goal oriented on, I want to buy a house that's going to be worth 30% more 15 years from now. I'm never having that conversation. That conversation never gets popped up with 95% of my clients that end up buying a house. It's trying to fit a budget that fits their life and trying to find a house that fits their life. And I think if you're there for a long period of time, more likely than not, the longer you hold real estate, the more you can absorb a moment of devaluation that occurred during your ownership, right? People that bought a house in 2000 and sold it in 2018, let's say pre-COVID, they probably didn't even notice 2007 and 2008. They bought it in 2000 and they owned it for 18 years and then they sold it in 2018. So it's the same idea. Even if you were selling a house in 2007 or 8 when the market was down, year over year, maybe it's not down for the person that bought in 1995.
Yeah.
Right.
For 200 grand and they're selling it for 450 in 2008, but it was worth 550 in 2006. So it becomes really nuanced to their situation that I think if people are making decisions on like what the market might be in 2026, and that's your decision factor for what you want to buy in 2025, I think you need to have a conversation with someone else about like, either you're a real estate investor or you're buying a house to live in, is my
Right.
And I've dabbled in both. I grew up with a real estate investor. It's a completely different mindset. So I think that's my big takeaway on prices and what's going to happen. And the fear of a market correction is it's going to be really hard if you're a buyer in 2025 or a sell by client in 2025 and you're waiting for that. You're most likely going to be very disappointed. I mean, like you said, all those people then they're still renting. I bet they're not thrilled if they do the math on how much money they've spent on rent. They probably don't do the math because it hurts.
Yeah, I can tell you it's upwards of like 142K easy if they've still been there. And I'm thinking like right now, even like if you were waiting for, again, not to use that word, but crash, like 2023 and 24 were probably it. Like we've been, when they see like units sold, we've been sitting at the bottom now for the last 2 years. So I can't really see a scenario in which the market gets much worse than it did. And even at its worst, it was still a seller's market. Like even when we started to approach like an absorption rate of 4 months supply, it still was a seller's market. Yeah, we would need extremely high interest rates for what people deem as extremely high. I think if a 30-year fixed rate was 10+% for top tier financing, we would 100% see prices correct. Totally. Buyers would just go, no, I'm not doing that. Like we already kind of saw that at 7%. And I mean, when we flirted with 8% for a little while.
I was going to say 8 was. Yeah.
I flat out I had 3 deals just fall apart because rates were like, no, I'm not even going to do that. They were negotiating offers. And then when I gave them the updated rate, they're like, nope, we're not even going to continue negotiating. We're going to wait till they're back in the low 7s. So I think it's going to take a really high rate for rates to impact pricing. I think the biggest impact to pricing right now is just supply and demand. We just we're millions of houses away from making that an equilibrium across the board in terms of demand versus supply, right? Like there's a wide deficit and interest rates aren't going to move that needle. It's going to be a lot of building, and we're just not seeing a lot of building in Massachusetts. So if you're a buyer of real estate and you're thinking you're going to live there for the long term, it's most likely a pretty safe bet. There's no guarantees, but I would say don't try to time it perfectly, right? I think it's very hard to do, right?
Yep. I mean, all of our, like you said, Moriah, I even had people in 2020, 21 actually end up buying a house, but being like, oh man, like this is such a bad decision. I'm paying so much money, I'm 40,000 over ask. Well, what are they sitting on, about 150K of equity right now? So you never know either way. It's 2 years from now, the market could crash. But if you're living in your forever home and, you can make those monthly payments and your family's happy and healthy, what does it matter? Or it could be the flip side.
We heard a lot at our Pi Day event of people saying, I'm so glad I listened to you. I'm so glad I bought when I did. And you're right. In the moment it was, okay, you're going to give up your firstborn and give the seller 50 over ask, and they're going to tell you when we can close and whatever. And now they come back to us and it was the best decision they ever made.
Yeah.
The best time to buy was 5 years ago, is like one of those sayings that always makes me laugh.
Well, that's what's the tree saying? The best time to plant a tree was 20 years ago. So on tomorrow, like you can't. Real estate's the same. The best time the worst things that I see are and what I mean by worse is that just gives me anxiety and I almost don't want to see them, is when people are like, here's what $10,000 invested in Apple stock in 1992 would be.
Totally.
Oh no, I don't want to see that. I don't want to see any of that, because it's like, that would be $450 million. It's like, oh God. I think that's very similar for real estate, is if you're and that's really the Warren Buffett way of doing it, is if you're bullish on real estate, which means I'm buying my forever house or I'm always going to own and not rent that I can, you're not really concerned about market corrections because you're viewing it as this is always going to work out better than it not work out good, right? Because I'm not selling real estate next week because I'm bullish on it and keeping it. But I'm buying the company and keeping it. I'm buying real estate and keeping it.
I'm going to start asking my clients, oh, I didn't know you planned on flipping this.
Yeah. Mm-hmm.
That's where I go. And when they go, no, I plan, and that's one of my questions I go over with clients is how long, what is the style of house you're buying? Are you buying a forever home or are you buying a starter home? Because I think there's a couple different strategies. I had clients that year-over-year statistics do matter. He works adjunctly for the military and gets moved every 3 years. Then it matters. Then it does. Then it's okay. You need to have some strategy here because now you're flirting with being a real estate investor. You can try to analyze trends and what neighborhoods you're buying in, and can you build some equity and what's your payment? Could you rent it out? You got to ask questions that most buyers aren't asking, which is, I want to live in this neighborhood because it's good for my kids to run around, and I want to be near this school. Those are usually always things that help value too. But if it is short-lived, you've got to be asking the right questions. I think there's a couple of different stories in real estate that occur, right? There's the people that bought a condo in Southie in 06, that their starter condo, and went to go sell it in 09 and lost their shirt, right? But then there's the people in 06 that bought the starter condo but had the right conversation and the right mindset at the time and said, well, if we're ready to move in 09 and we're cool with being a landlord because we're buying our starter condo that now doesn't fit our family, what does it look like to buy? Can we save some money now and not do 30% down? Maybe we do 10% down and keep some liquidity on the sidelines. And that's when I have those conversations with clients that even start flirting with the whole market correction fear, if you will. I go, well, if you do this strategically, right, and that is your fear, and you have the right people in your corner, the right realtors, the right attorneys, the right lender, now you can play the game like the Warren Buffetts. Because the people that in 06 that bought real estate and didn't sell or have to sell in 09 and navigated through that market are sitting really pretty. And or they bought in 09 during the downturn. That's how you play that game. It's real estate's very long run unless you have to sell. So I think that's the
and I think you said it perfectly, Mike. To having the right team around you, the people that are day in, day out looking at the market, understanding these trends, being able to advise you is so important.
If you're not paying attention to the market, and that's like what we're doing here, and knowing, I mean, don't listen to the guy I said earlier, Uncle John's second cousins, whatever, talk to somebody that's like chewing on the market every single day when it comes to pricing, rates, inventory, all that. Like, I feel like, not to toot our own horn, but I feel like the three of us know the market on like a granular level. So when I'm giving advice to clients, I can feel confident that, well, Mike just told me this, or, Cassie just pulled the numbers for that. I always kind of have that data like at my fingertips. So,
I have one nugget that I give my clients that I think was the best epiphany for this scenario, which is don't take advice from someone you don't share your income information with, or you're willing to tell them how much money you have in the bank, how much money you make yearly. And when I tell that to clients, I'm like, that completely gets rid of the media. So if you put the news on, don't take advice from anyone on the news because you're not sharing anything with them. And that removes most of the people you talk to on a daily basis. So your Uncle Jerry who sells cars is telling you don't buy real estate because the market's going to crash. If you don't feel comfortable telling Uncle Jerry how much you make per month and how much money you have in the bank and those like intimate financial details, don't take advice from him because advice is nuance for your situation. It's just It's just information. It's not real.
Even if Uncle Jerry's well off, he, like to your point earlier, he did that at a time that no longer exists. So he how he made his wealth. The market of yesterday does not apply to the market of today.
Yeah.
So, well, I think that we had some great content here today. So
Yeah.
for anybody that has tuned in for breaking down what we think will happen in 2025, again, we don't have a crystal ball, but based on an in-depth look at 2024 and some things that we can peek into for quarter one, gives us a good idea of what we think may happen in 2025. And it will be interesting to play this back in December of 2025 and see where the market did in fact land. And just Mike will put your contact info. So anyone that has questions about getting pre-approved for the new year, if that's on their goal list, they can reach out to you to see what their rate will be. So I know my clients in 2025 or in my clients in 2024 that were looking at rates and things found their best rate with you and guaranteed rates. And everyone that worked with you was thrilled with their experience. So thank you for helping our clients in 2024.
Yeah, definitely.
Thank you for trusting me.
Awesome.
All right.
Well, thanks again. And tune in next week for our next topic.